Hello and good afternoon, everyone. Thank you for coming to today's session. I'm Jessica Inskip, and we are going to do another presentation with Firstrade. And today we're going to focus on cash covered puts. And there are certainly a lot of uses with cash covered puts. A lot of times it's used to add positions to your longer term portfolio. And we'll talk about that, and that'll certainly be the focus today. But we'll also discuss the components of it and how you can use it to enhance your portfolio and the purposes that it serves. But this is certainly a focus on income and long-term generation. But of course, before we dive in, I do want to go over a couple of details and disclosures. And before I do that, I'm Jessica Inskip. I'm the Director of Product and Education over at Options Play. Love doing these presentations with Firstrade, lots of great information and wonderful questions. And so there's a lot of great information here, and it's so important to put education first. So we certainly appreciate you taking the time to focus on that educational aspect. And naturally, we do have to give you a disclosure from an Options Play perspective. Note that we're a third party. We're not affiliated with Firstrade in any way, shape, or form. There are a lot of examples that are within this presentation and research tools. Those are for demonstration purposes only and not considered investment recommendation or advice of any way, shape, or form. It's for illustration and educational purposes only. And they are a lot of examples throughout this presentation. And no, those do not include commissions or fees. That's important to know. And from a Firstrade perspective, know that options are complex. They involve risk, so which means they're not suitable for all investments. So there's a lot of requirements that have to be met, a separate approval and application process. There is a disclosure document that you probably receive or seen if you've had options, but it's something that you're required to see. It's something that the OCC puts out, and I plopped it in the chat. It's called the Options Disclosure Document, also the Characteristics and Risk of Standardized Options. Essentially what that is a documentation that the Options Clearing Corp or OIC puts together. It has all of the terminology that goes in with options. It gives you the risks, so meaning risk potential, gain potential, and the different intricacies that go along with the options that are, complex. And so therefore there's a lot of material that goes with that. So now that we're covered from a important information and disclosure perspective, let's go ahead and dive in. So we're going to talk about today is we'll focus on what a short put is. I'll also do a quick review of the basics, just in case you haven't traded options before, but that of course will be focused on short puts. So pulling out the information that you need. We'll go through some examples. We'll talk about optimal trade setup and why. And then of course, we'll talk about finding opportunities and ideas, utilizing the tool that you have available to you, trade management, which is ever so important. And of course, we'll save some time for questions and answers at the end. But what I want you to focus on, and this is the question we're answering, is how can I invest for the future at a discount utilizing short puts? So what exactly does that mean? Well, in order to understand that, we have to look at what an option is. So an option is a contract between a buyer and a seller. The buyer pays that premium and the seller receives that premium. The buyer can execute upon the terms of the contract, which is the rights that the contract contains, and the seller is obligated to fulfill those terms. And if it's issued as a call, that just simply means it contains the right to buy. If it's issued at a put, it contains the right to sell. So like this example it has 100 shares of ABC at $100 per share. It's considered executable at any time through the expiration period, and the buyer pays a premium in order to execute upon the terms of that contract. Which means, think about this from the buyer's perspective, and I saw a question that came in there with assignment, so we'll also talk about that as well. But from a buyer's perspective, they own the right to execute upon the terms of that contract, which means they want that contract to have as much value as possible. So if this is put and the contract contains the right to sell 100 shares of ABC at 100, well, that contract is going to have as much value as possible when the underlying security is well below $100 per share. It's going to have more value when ABC is at 90 at the market, because I could utilize the terms of this contract and sell ABC at 100. Even more value when ABC is at 80, because I can buy at the market at 80 and utilize the terms of this contract and sell at 100. From the seller's perspective, they're obligated to take the other side. And so when focusing on utilizing cash covered puts or a short put, the other side of that contract, the sell side, we're utilizing the obligations inherent of options contracts as entry points. That's the purpose of this. So the seller, the obligation contained on the put side is an obligation to buy at 100. And that obligation only kicks in if this moves adversely in the buyer's eyes, because remember, the buyer's in the driver's seat, the buyer can execute upon the terms of the contract, the seller is on the passenger, meaning, and I love using a car analogy describing options, because if you are the passenger, you can just be aware of your surroundings and understand if assignment is likely, or if, which is another word for that obligation kicking in, because we can see if the driver, think about when you're in a car and in the passenger side, you can see if there's a stop sign ahead, or perhaps a red light or yellow light, or a turn. You can get an idea. You don't know if they're stopped there, but you can get an idea if they will. And the same is true with options. We just have to look at it through the lens of the buyer. So the seller individually, max gains achieved on the sell side if the option contract does not have any value, because we do not want the buyer to execute upon the terms of that contract, because we don't want to fulfill our obligations. And utilizing cash covered puts to buy stock, we're kind of flipping that narrative, or we're utilizing the obligation, understanding our obligation, and therefore wanting to only do this on securities we're okay owning if it moves adversely. And we'll talk about optimal environments and how to maximize that thought process. But just from an educational perspective, on the eyes of the put, the buyer in this scenario would want ABC to go down as low as possible. If ABC goes down as low as possible, this contract will continuously go up in value until ABC goes down to zero. This is the risk profile is just the opposite for the seller. That since that contract goes up in value when ABC goes down, that is equals the risk associated on the sell side, because I am obligated to buy ABC at 100, and the lowest that ABC can go, of course, is zero, which means they have substantial risk potential. And that's the way options work, just like that. The options buyer has substantial gain potential in the eyes of the put because the underlying security go to zero. Seller has the risk potential. Everything is a mirror. That's why we always show that T-chart. And of course, we have it in here to give you an idea and focus on that. So that's just your quick, what is an option, focused on, of course, the put side. We'll go a little more detail into that as well. So I think it's very important to cover. But with any contract, you have what quantity are we agreeing on, what product are we agreeing on, what price are we agreeing on, and what time frame. Literally, options are full of jargon and terminology. And if it seems like it is legal jargon, it literally is, because it is a contract between a buyer and a seller. And that's why I like to reframe the terminology into questions and just see it that way. It helps simplify complex concepts. So the quantity is literally just the contract amount. Remember, one contract always represents 100 shares. I'll say always. There are some instances where it could not with adjusted options, but generally speaking, it is 100 shares. The product that you're agreeing on, that's just the underlying security. And it can be a stock, an exchange traded product, an index currency, or even commodity. We say exchange traded product because that could be a fund or a note, but know that you cannot take ownership of an index. So we're actually going to focus on equity options, which are stocks and ETPs, or exchange traded funds and notes, also known as products. The price, just another word for strike price, just means what is the price that I have agreed to buy the shares at, or I'm obligated to buy the shares at if the options purchaser of the put decides that they want to execute upon the terms of the contract and sell the shares. It's priced per share. So that's why we always look at it on a per share basis and multiply it times 100, whatever algebraic equation you want to apply, absolutely works. And then the time frame is just the expiration date. So how long is this good for? Normally on Fridays. I say normally because now there's some that expire every day, but it honestly depends on the type of product. There are some securities that have a lot more liquidity, meaning a lot more volume. They trade more, they have more open interest, whereas others do not. And that really depends on they generally, if they're traded more often, they have more expiration dates, and some are at literally every single day. And then just to put that in terms, it's 1 ABC 100. I apologize for not updating the dates here, but 1 ABC 100, July 29th. Let's pretend that's 30 days until expiration. That's all that is. So I would see that on my positions list and I'd say, okay, I've got a contract that represents 100 shares on ABC. The strike price is 100, and that is for the next 30 days. The issued as a call or put, we said that. The call just means it contains the right to buy. Put means it contains the right to sell. They can be exercised. Remember, that is only something that the buyer initiates. On the sell side, we're obligated to fulfill those terms, and that's called assignment. They can expire, which may be our goal. In this case, our maximum gain is going to be realized on expiration because we'll keep that premium. So if it does expire, worthless. But know if you hold something until expiration, that also increases risk, especially if something is already in your favor. We can take risk off of the table. You do, of course, take away the potential of your maximum gain potential, but that is, of course, with the benefit of taking risk off the table and it moving adversely and moving into substantial risk potential. So that's important to think of. And that's why we talk about exit strategy. And of course, they can be traded. 70% of options are traded on the secondary market. So that's when you buy to close your option or sell to close your option. You take that other side. And that's because options are priced based on their premium, and they have other components that are associated with the underlying security outside of just the underlying security, which is the extrinsic value, time taken into account, implied volatility, even interest rates and dividends. Those are all components that make up an options premium. And it's important to know what that's comprised of and what affects that options premium, because that's actually how we define our optimal environments. If we have a view on a security and we want to trade options utilizing that view, we have to understand our optimal environments, which is literally, is this more expensive than usual or not? And that all comes with understanding the options premium. And if something is more expensive than usual, you probably want to sell it rather than buy. You don't want to buy something that's overly priced. So that's why we focus on the premium. And actually, before I go into this slide, I'm gonna skip over to the premium because I did have a longer review. The premium though, so we'll run through this and then we'll get into the meat of it. Made up of intrinsic value and extrinsic value. Intrinsic value is just the money value. So for a call, if it moves above the strike, moves in your favor, we've got executable value. That's all that means. Extrinsic value is mainly time value and implied volatility. Again, dividends and interest rates is also a component of that. But that's important to know from the sell side or even the buy side, because we need to understand our sentiment and we need to understand optimal environment. So when I'm trading options, those are the two things I'm going to start with. I have an underlying security. I'm going to define my sentiment on that. Am I bullish, bearish, or neutral? I also have a market view too, where I think that's going to be, and also understand my risks around the market. Is there a big market moving event coming, like earnings or a Fed decision we're in the midst of right now? How does that affect my options premium? And then I'll make sure that I define my optimal environment based on knowing how it affects my options premium and my direction. And we'll dive deeper into that. So time value, the more time you have of an option, the more expensive it is, which means we're never going back in time. So as we approach our expiration period, of course, it's going to lose value. It's absolutely going to lose value. But it's not linear either. It really falls off of a cliff about 14 to 21 days until expiration. We call that theta decay, which is that daily time decay, which theta also is extrinsic value decay, not just time value. I think that's important to delineate. But that's something that helps us on the sell side. So that's important to know. And how we come up with optimal expiration dates is this component right here. That helps us with strike selection. Implied volatility So the definition of implied volatility is the market's anticipated movement of the underlying security. And a lot of times that's defined, or it is derived from, options prices and extrinsic value components. What people are willing to pay for something. That's even how the VIX calculation is utilized. It's SPX contracts with a 30-day period to define literally implied volatility of the entire market, or volatility of the entire market. So something like an anticipated earnings announcement inflates implied volatility. Logical, right? Because we expect an anticipated movement in either direction. Therefore, it's going to inflate the options price. But once that market moving event has happened, it deflates. So that's important to know. We want higher volatility, or for an implied volatility, not volatility in the market, but high implied volatility, or something that's making this options more expensive to be on the sell side. That's how it inflates that price. So it's important to know why it's there, but also if it's there from a risk perspective, which is earnings, it's going to deflate, that could help us, but also risk from the overall macro market is that purely just inflated volatility. Like we're in a bear market right now. So there's lots of volatility. We have large swings up and down. How do we capitalize on that? And that's what we're going to focus on. But where optimal environments and strike price selection come from is literally these components of a premium. And the way that I like to remember these in my mind, intrinsics, internal factors, extrinsic is external factors. Internal factors is the underlying security. That's literally it. External factors is time and implied volatility. So things that we can look for in our passenger seat. And what's important with time decay, it is purely executable value. And as your option nears expiration, it is only going to be worth its executable value. Why so many animations there? So as it moves on expiration, it's just worth its executable value. And that's important to know, especially if we're on the sell side. And if we're on the sell side, the goal is to buy back at a lower price. And so we need to know the decaying factors of our option to optimize that. And that, again, strike selection, so on and so forth. So now I'll bring back this slide, which is our 4-quadrant. And if you haven't seen this before, we utilize this and build on our entire options curriculum all the way to the Greeks. Every time we pull this up, somebody wants a screenshot of it, or it's a really great tool just to understand options in general. And I'll show you what we can focus on as we're looking at short puts. But this is where it goes into optimal environments. And hopefully this clicked. When you're buying options, which is the long call and the long puts, or let me take a step back actually and just give you an overview of the setup. Calls are on the left, puts are on the right, bearish strategies are on the top, or excuse me, bullish strategies are on the top, and bearish strategies are at the bottom. So that gives you just a quick view, and you'll notice everything is a mirror of each other. And we talk a lot about strategy drivers, especially when you get to multi-leg options. So if you just learn these 4 individual strategies really, really well, that's how you graduate into multi-leg options. But to even take it a step back or backwards, if you just focus on long calls and you understand them really, really well, that's how you learn options. That's how I learned options first, is long calls with a quadrant like this. You can utilize a chart like this just to understand everything else. Now, as far as what's applicable today, because this is not a beginner session, so but I wanted to make sure you have that solid foundation in case it wasn't there. And it's always good to reiterate. Anything you're purchasing, time is working against you, because remember, if we're buying a contract, we can execute upon the terms, which means we want it to have as much value as possible, which means if it has as much value as possible, it profits from a sharp movement in its favored direction. The opposite's true on the sell side. So if we're short the option, we sold for a premium, we have an obligation to fulfill the other side. So therefore, we don't want this to go up in value as much as possible. We want it to decay. We don't want it to have any value, which means time decay is positive for us. That actually works in our favor. And we profit from a neutral or just a slight movement in our directional bias. And that's what we're going to focus on as we talk about optimal environments and setups. If you are expecting a sharp movement and you want to capitalize on that, there are certain risks rewards for everything here. Sometimes taking a directional move is optimal because of your goal associated with it, as long as you take into account the time decay and how you feel about the underlying security. Whereas if you don't expect too much movement or for it to stay the same, or you expect volatility to come down, then taking the sell side makes sense. So that's where this really ties into setting up your options trade. All right, so let's talk about a cash covered put. How do we set that up? Now, remember, the long put holder has the right to sell at the strike price, and they can do that at any time. Does it make sense for them to do it at any time? No. Are they going to do it at any time? No, but it's possible, and you have that obligation. So that's what you have to know if you're selling a cash covered put. The reason why I say is, are they going to do it at any time? You just have to look at your surroundings. If there is more extrinsic value priced into that option, and it's pricing more than just its executable value, it doesn't make sense for them to go ahead and execute upon the terms of that contract. They would get more money closing it on the market. And that's why most options are traded on the market. It doesn't make sense. And sometimes it requires more capital. And you have in a whole new position. But in order to create a cash covered put, you have to be able to fulfill that obligation. So you have to have the cash ready available to buy 100 shares of that optionable stock or exchange traded fund or product. You sell a put option and you utilize that cash as collateral and receive a premium in return for the obligation because you sold it. So now you have an obligation to buy that stock at that specific strike price. You still have substantial loss potential. So if you haven't seen a profit and loss diagram, I think they're a great visual of options because it gives you an idea if something's bullish or bearish. And sometimes their loss potential depending on where it's viewed. But the top part here is gain, bottom part is loss, and this is the underlying security moving up in value. So this tells me that this is bullish, has a capped gain potential, which is if the underlying is just above my strike price. If it moves above my strike price, I'm not making any more money. That's it. And that's why it profits from a neutral to a directional bias. Your gain value does not go up if the underlying security skyrockets. That's one form of risk. You break even at expiration if the underlying moves against you equivalent to the premium that you received. So if you received $5 and the strike was 100, if it moved to 95, you're going to break even because you received $5. But you also have substantial loss potential because at that case, you're going to own the underlying security at 95 and it could go to zero. Now, keep that in your mind. If we are looking at, I have Apple here, and we know Apple is not this high anymore, but I think it's a great example and I left it there for a reason. And no, this is purely for example purposes only. If you were deciding that you're going to buy Apple and you say, you know, I'm bullish on Apple, I want to buy the shares. Maybe it's now, maybe you're waiting post earnings. Let's say they're the only tech company that didn't hire crazy over COVID. So therefore, I don't think they're susceptible to layoffs. They might have better management because of that. Whatever your investment thesis is on buying Apple, you'll also have a price target associated with it. Say, you know what, I think it's going to go to 175. Maybe that's from a technical perspective. Maybe that's an average of analyst targets. But meaning, before you enter into this mindset of placing the trade of Apple, if you're just buying the stock, you have an investment thesis, and that's very important. And if you don't, you should. And there are lots of tools and resources that are available to you on Firstrade's platform to give you that. And then, of course, you take it the next level when you add options, but you also add complexity, and that's important to know. But if you were going to do this, say you were going to buy Apple and you were going to do it with a limit order, you'd put in a trade to buy 100 shares of Apple at 160. Your risk is $160 per share, 16,000, because you can lose as much as you spent, but your reward is the price target difference. So the $15 per share. You're willing to risk $16,000 to make $1,500. That's the risk versus reward framework that I want you to keep in your mind. Your loss begins if Apple moves down from its current point. And of course, you have unlimited gain potential because you own the security. And as Apple moves up in value, you'll also make money. So this is where, if you're an options trader and you've decided, okay, I want to buy Apple, but instead of using a limit order or market order, my normal market mechanics in order to buy Apple, I'm going to go ahead and sell a cash covered put, but I'm okay buying the stock. And I'm going to utilize my obligation that I know I have. And if it moves adversely, which can happen, I'm okay with it because I want to own this security long term. So what you do here is you'd sell, maybe it's an at the money at this case. An at the money option has a higher probability of moving against you, I suppose, because it's very close, literally 1 penny up or down, it's in the money. For $3.15, that's the amount of premium that you receive, so $315. You've reduced your risk by that amount of the premium, and you've increased your reward potential by that amount of the premium. That's where time frame is extremely important, and I'm hoping your mind is focusing on, hey, we just looked at that 4 quadrant, and we were talking about if I was directional, that perhaps I'd be better taking a different view. And that's true. And that's what I want you to know as well. Both of these have substantial loss potential. Your loss potential when you buy the stock is how much you spend. Your loss potential is owning the stock, but it's reduced by the amount of the premium that you received. This moved ahead on me. I apologize. The other risk potential here is if you sold the cash covered put in order to buy this, you're going to realize maximum gain if Apple is above this 160 strike price. But if it makes it all the way to 175, this would have made more money. And that is important for you to know. And that's why time frame is really, really important. But if this moves adversely, your short put would have lost less. So there's always something offsetting the other. If you're going to give up reward for gain potential, things of that nature. And that's why, again, why time frame is so important, which we'll talk about. So let's talk about optimal short puts. So got the security here. Now there is an optimal environment that I'm going to look for. And on the options play tool, we show you IV rank. And that's going to give me an indication if something is more expensive or not. We don't have to look and calculate extrinsic value and compare it to its previous extrinsic value. There are lots of tools that do that for you. And so that's why this tool was built to give you the option-specific information that you need. Know that owning the stock, you also are entitled to the dividend, whereas selling a cash covered put, you are not entitled to own the dividend, to receive the dividend. So that's something important to know as well. And when those dates are. Earnings is also extremely important to know because that inflates an options price because of implied volatility. So if you, depending on your directional view, that's just something I would be cognizant of. Sometimes we tend to avoid those because it is volatile. But if it's something you want to own long-term, it's okay. That's your decision and something to take into account with your risk profile. So you have the underlying security. This doesn't have a high IV rank. Anything over 50 tells me it's higher than normal. This is lower, but we're still going to say, okay, you know what? I still want to sell a cash covered put. I'm not interested in buying calls to take a directional view. That's not the type of trader that I am. I just want to own the security and sell a cash covered put in order to own that security. And that's fine. So in this case, we have deltas shown here, and we have the optimal expiration. Now the optimal expiration is 30 to 45 days. And that's because of that 14 to 21 days extrinsic value depletion that occurs. We have to take that into account. We want to be able to maximize on that because if this underlying security doesn't move whatsoever, we want to make sure that the premium goes down in value and we sell as much premium as possible, but we also can close out that position prior to till it expiring. And that's why we say 30 to 45 days. We want to make sure you account for time to have some of that theta decay. Again, your choice. And it's just important to understand how theta decay works. That also means when we say 30 to 45 days, you're not holding it for 30 to 45 days. When you choose an expiration for options, that's not your holding period. That's not your target period. That just means this is when this expires. And if you hopefully don't procrastinate a lot of things, but if you have a contract on or a coupon on something, you're hopefully not waiting for the last day, because now you have a risk of just something moving adversely, which is true with short options. You hold something until expiration, especially if it's in your profit point, you have a higher risk of it moving adversely and moving to you not being profitable. So in which case, it's absolutely okay and makes sense to take risk off of the table. Again, if you take risk off the table, you still lose maximum gain potential, but you gain less substantial risk. That's the important component. Now we have 3 different strike prices here based on the underlying. We talked about delta briefly, and in our previous sessions, we've done some great details on the Greeks, and delta is used for so many different things. In this case, we're using it for a probability of expiring in the money. And that's about it. A 0.47 delta or 0.5 delta, that is normally an at the money option, which is holding true here. I see 165, 165.21. Normally they don't have cents increments. This was taken around a split, so there are some there. So this is closest to the money. That's going to collect me the highest premium because theta and vega, all of those external factor Greeks are centered around at the money options. That's going to give me a raw return of 2.9%. And that's just taking 485, dividing it by this. And that's where this return is coming from. And my break even at this case is 160.15. So if 165, or excuse me, if Apple was going to move down, that's my break even. 162.5, collect 390. That's a smaller delta, which means it has a less probability of expiring in the money, which means a lower probability of having value, which means it's going to move. I'm going to be able to keep my premium. And because of that higher probability win rate for you, you get less premium, less raw return, but you do have a different break even because of your strike price. And then hopefully you get the drift here, the 30 delta, flex 310, 187, break even is 156.90. Now, if you were going to select these, the optimal, or it's really your choice, but if you want to maximize theta, or the extrinsic value component, that is the highest, closest to the money, which is very, very clear here with the amount of premium that is here. That would be an optimal expiration that the tool will prompt for you. If you feel, now this is where you can have a little bit of directional bias. And sometimes we talk about this when we do our trades, especially with times of volatility. So if you were looking at this security and you say, you know what, I do want to buy Apple, but I am afraid it might go down to this support line, or I feel it may move down in value, I am okay collecting less premium because I want to reduce my risk exposure because I really think that's going to happen. So that's why I would choose a lower strike, something with less value, because remember, we're talking about puts, which means they contain the right to sell. The right to sell at 165 is the highest value as compared to 162.5, 160. Makes sense, right? So that's where I would adjust. That's why I say it's important to understand your sentiment of the security. And that's why we layer on technical analysis. Your investment thesis of why I want to buy an underlying security, sure, it can be based on fundamentals and technicals, but then technical analysis gives us an idea of just support and resistance zones to give us an indication where there's a large area or cushion that may be support where the security stops going down. And if I feel it's headed there, like in this scenario, perhaps it could go to this support line, then maybe I want a lower strike price to just reduce my risk exposure. Just like you would set a limit order at a specific support zone. Same concept. All right. Now at Firstrade, you do have a tool for this, and that's important to show you. You have the options wizard, which is where you can plop this into that tool where it's going to give you have your investment thesis, you have your underlying security, and you can compare 3 different short puts next to each other or various strategies that are bullish individually, but it's designed so you can focus on risk versus reward and your sentiment. That's extremely important, is to get away from the jargon and the complexities, think about risk versus reward. Because when you add the layer of complexity of options, it has an expiration period. So we have to think about that and skew risk versus reward in our favor. This short put report, so that's one way we trade options. The other is by screening options and looking for something that has an optimal opportunity in those optimal environments. And that's where there is something that has an inflated value and meets the criteria that could be an optimal premium selling component. And will show up on the short put report that you have available on Firstrade's platform. There's information that's here that's extremely important, like an earnings date, because this is going to show up and it's going to be sorted here by raw return, or you could sort it by raw return because that's going to optimize premium. But if that's only having a high raw return based on earnings, that's important for you to know. That's why there's an earnings flag. That's why you can have an idea of what's happening. Then, of course, the expiration period, mid-price, strike price, the information you need from the options level, the current stock price, so is it closer to the money, is it far away, and then days until expiration. So it's going to be different information that you'll see from the covered call report or the credit spread report, because there are different risk factors that are associated with it. And that's the beauty of options. You can create and layer option strategies to be profitable in any type of environment, which is, neutral, bullish, or bearish. However, because of that layering that you can do with options, that means there's different risk profiles with each strategy that you have to be aware of and different data points that you take into account. All right, so let's talk about some outcomes and what will happen in management. So this is going back to that example we had before. Let's say that we have our underlying security and we decide to buy at 165, or we have our 165 strike. We sell a put and collect $4.85 worth of premium, which means we need to have $16,015 in cash. So you'll need $16,500, but your $485 offsets that because you're receiving some premium. So that's reducing your risk potential, but still that's set aside because it's your risk potential. If the security, this is where it's important to know, and I love to visualize it with the graph. If this moves above 165, you're going to keep that entire $4.85. You made 2.9% from a raw return perspective. You could even, again, roll your option and go out another 30 days. You can roll it to a different strike price if the security is moving up. There are lots of options that you could do there. Pun totally intended. Now your break even is reduced by the amount of premium you received. And if this underlying security moves down, you are the option's going to lose its extrinsic value component, which is what this was primarily made up of. But as it moves down and it loses its extrinsic value component, it does start adding its intrinsic value component, which is just its executable value. You'll be assigned, you could be assigned early, and normally that happens if all extrinsic value is gone. But if you took this from a snapshot in time, instead of purchasing the security at 165, you purchased it at 160.15. You were able to capture a 3% discount in comparison to just buying at or around 3% from buying it at that time. And that's how options traders will utilize cash secured puts to buy stocks. But it's important to know, do I feel like this security is going to rally like crazy? If so, I would have made more money buying the security. That's important to know. But if I feel that perhaps it may retract slightly or stay above where it is and has a slight directional bias, meaning literally the amount of the premium. If this was to go up to 169.85, that's still the equivalent of buying the shares at 165 because you brought in $4.85. But if it was going to go above, we'll call that 170, then you're losing out on upwards potential. But when that happens, that's when I would immediately, this put will lose value at that point, because the right to sell at 165 is not so valuable if the market's trading at 170. So if it moves to that point, I'm going to consider rolling this option probably to a higher strike price out another day. And I should be able to buy to close that option back at a lower price than what I originally sold it from, because some time happened in between there. So I had some extrinsic value losing, and it's farther away from the money, which extrinsic value is centered around at the money. So I had a little bit of accelerated extrinsic value loss. So that's how we would also utilize this to manage it. But that's why it's important to know all outcomes of your trade and just literally think of it from a risk versus reward or profit versus loss. If ABC was to move above 165, okay, I made $4.85. Let's call that around 170. If it moves above 170, I'm losing up on any more upwards potential. Why would I keep owning this security? The risk, the substantial risk that I have if it moves adversely, it's only going to increase. So that's important to know. And the same also happens on the downward side. If something moves against us, we sold this knowing that we wanted to buy the security, but that's why your investment thesis is extremely important. If you decided you wanted to buy this post earnings or whatever it was, and you see this support line right here, and you say, okay, this was old resistance, gapped up, went above that. I'm happy owning the security if it makes it right here. But if it moved adversely and passed through that, I would also reevaluate my sentiment, because at that point, my investment thesis was incorrect, in which case we move on to the next trade. So that's also important to know. So we do have some tips and tricks for finding yields and utilizing the tools that you have available to you at Firstrade. So first is focus on stocks that you're familiar with and comfortable investing in. And that's because of that investment thesis. And that's something that I feel like throughout my whole 14, almost 15 years in this industry, something that someone taught me very early on is when you're starting investing, they always say, even if it's stocks, what's something that you know. But the reason behind that is so much more than you think. We work in the market every single day. So there's a little bit different of knowing or nuances. But if you're in marketing or you're an engineer, you're going to know the intricacies of that field so much better than anyone else, because you've built a career on it. So when you built your investment thesis on something that has a focus on engineering, or you realize that there's a trend within your industry, or from a marketing perspective, that's what we mean by saying investing what you're familiar with. You're familiar with that industry and know it really well, and that helps develop your investment thesis as to why you should buy that stock or why you should sell that stock. Are you a bull or a bear, or do you think it's not going anywhere because it's waiting on something? That's what that means. The second part is high yielding income portfolios as you sort by raw return. The purpose of selling cash covered puts is from a yield component, because you're collecting premium, and we want to be able to maximize yield on your portfolio. So it's one component of the wheel strategy, which we'll talk about and then on our next session. And the previous, of course, is on cover costs. We're going to bring it all together, but it's a focus on return. We want to maximize yield so we can reduce our substantial risk potential. If you have a small account, these require a lot of capital, but you can sort that report by stock price. So that doesn't mean that it's a better stock. That's important, and your analysis is there, but purely meaning you have as much capital set aside as how much it costs to buy something. So if you're looking at Apple, versus something that's lower. Those are just examples. It's just the amount of capital set aside for something that you want to purchase. And with options and even risk management, it's super important to not put your entire portfolio in one trade. That's how you blow up your account, because you will be wrong on one trade. It will happen. You're not right on every trade. It's a better way of saying that. But that's why we always say focus on risk versus reward, because if you are wrong, and when you're wrong, if you've skewed risk versus reward in your favor, you are making up for that. It's easier to overcome a 5% loss than a 20% loss because you're allocating accordingly. And then earnings, sort by earnings flags, because implied volatility, that's one of the main reasons it starts increasing for an underlying security. Right now, we're in the midst of biggest earnings week. It's this week and next week. So I expect there to be a lot of flags because of that. That's important to know because that equates to risk, because it's a likelihood of anticipated movement. And as the previous slide depicts, that could determine our substantial risk potential or upwards potential. And then we have some what and when or tips and so on and so forth with utilizing cash covered puts to buy stocks and ETFs. So this is not selling cash covered puts, but it's selling cash covered puts to buy stocks and ETFs with that purpose in mind. So when do you do it? When you are neutral short term and you're bullish long term, because this strategy is profitable if the underlying is just slightly above our strike price. So this is something that we want to buy long term, but we also know if the stock rallies more than the premium we received, we would have been better off buying the stock. You have cash ready to buy that stock. So your trade, you're going to sell a put obligating you to buy the stock at that strike price. And then just another depiction of that, the premium reduces your risk potential. You still have substantial loss potential, but it's reduced by the premium that you received, and you will not participate in any rally that is above the strike price plus the premium. That's what this represents. Your setup, expiration, we talked about it, 30 to 45 days, just to account for some theta decay, but also so you can sell some time decay. That's something that works for you on the options sell side. Your strike price, slightly out of the money or at the money. So that's a 45 or a 50 delta. Remember, extrinsic value is centered around at the money options, and which means the farther out of the money you go, the less it is, the deeper in the money, the less it is. And that decaying of extrinsic value is something that helps us as sellers. And that's why those strike prices are there. If you have a little bit of a directional bias, you can adjust, but I want to give you some methodology behind there. And then the tip that we add to that is just looking at IV percentile and using that short put report. Those are all optimized for increased premium or yield. And that's also displayed with an IV percentile over 50. And then that report, of course, will help you. And then the way that we would enter that is if the stock was at 165, just sell to open, one contract through expiration period, 165 put at 5. This represents that you're obligated to buy the stock at 165. Your max gain is literally the premium you received. Your max loss is buying the stock at 165 offset by the $5 premium. And your risk-free range is 160 to 170. Meaning if stock goes down to 160, you're breaking even. If it goes above 170, you didn't lose up on upwards potential that you could have had if you bought the stock. And then closing out, this is so important. You have a great investment thesis. You understand the pricing components and the optimal environment. Place your trade. However, we have to prepare if things move adversely in every aspect. And we also need to close out and take risk off the table if things move in our favor, because this is when we're adding options, and this is a longer term, more conservative use of options, you're still adding a layer of risk because there's an expiration period. Can't hold them forever. They cease to exist at one point. So these are just our general rules and best practices. Again, this is something you can adjust for your risk tolerance, but taking profit as 75% of the premium. So we can take profit at 375. It's not our max gain of $5, but that takes risk off the table. Take a loss at 100% of premium and allow assignment if you're still bullish. That's what's important to know, is we are utilizing this strategy in order to buy stocks. And so if you are reassessing and reevaluating, your investment thesis still stays true and you want to buy the security, great, allow assignment and then go from there. Or if you're not and you're reevaluated, once it hits 100% of premium, you say, you know what, this is not moving, or maybe there's some adverse news, you don't know. happens, we hit a recession, lots of things that could happen. You may want to adjust. And that's why it's important to adjust at these price points. And they're normally fundamentally driven anyways. And so in this case, we would buy to close. And then these, of course, are the prices. And we would also roll or evaluate on these two periods as well is important. Accounting for that theta decay, 14 to 21 days. See where the security is at that point and evaluate. Or if it rallied above our premium plus our strike price, because that, again, we can't participate in any more upwards potential. So in which case we could adjust. And if it did that, that means the contract went down in value, in which case we could buy it to close at a lower price. So normally when this happens, this is also triggered, but it's important to know what triggers that. So you can also evaluate in case there's inflated IV or something like that. All right. So that is it. We've got about 8 minutes for questions. If you want to pop them in the question and answers, I'm happy to answer them. And again, thank you for taking the time to understand and focus on education, especially with options. It's extremely important, something we love doing. And that options is such an interesting subject. So again, thank you for the time. Also, I will take this time if you have in the Q&A, if there are specific segments that you want us to do or educational sessions, please put them in the Q&A and we'll make sure that we account for that and ensure that we have, make these as valuable for you as possible. And yes, there should be a recording that will be made available for you. Firstrade will send that out. We absolutely do have other sessions. So we host these normally bi-weekly. The next session will talk about the wheel strategy. So that will be 2 weeks from now, but it's every other week on Wednesdays, normally at noon. And of course, if you have any sessions that you would like related to options, let us know and we'll make sure that we make that happen. Normally there's a lot of strategy specific questions. So either I did a great job of explaining or we're very confused. As a beginner, what session would I start? That is a wonderful question. So what we can do is our next session, we plan on doing the wheel strategy, which would be a compilation of the last two. So covered calls and cash covered puts, long-term income generating. But what we can do is following that is we'll kick off a series on beginner options trading. That way we have those sessions available. And what's great about them is we have designed it in a way where it all really flows and goes together. So you saw a very snippet of it in the beginning when we went over what an option is and pricing, but normally that is 2 sessions in its own. So we can start a series. If you'd love a beginner series, great, we can do that. So we'll kick off a beginner series where we go through that in detail. Normally, we also talk about directional trading, but that it's a longer form. Probably takes it'll take us 2 months to get through. But yeah, absolutely happy to do that. Will it be a day trade if the total balance is less than 25K? Pattern day trader. Well, it could be. In order to have a day trade, you need to open it and close it at the same day. But there are different rules if you're designated as a day trader. Imagine you have a margin account. And it would charge the naked requirement to you. But yes, it would absolutely count as a day trade if you opened and closed it the same day. All right. That looks like all the questions. So again, appreciate the time and investing in your education. We'll do the wheel strategy and within the next 2 weeks, and then following from there, we'll kick off a beginner series as per your request. So thank you so much again. Hope you have a wonderful day, and we'll talk to you soon.